Good evening, everyone. Thank you so much for joining us on this call. I'm Jharna Agarwal, Head of Products at InCred Premier, and I will be hosting this webinar today. We have with us our guest speaker, Mr. Aditya Sood. He is Fund Manager at InCred Asset Management Company. He has an overall 20 years experience in equity markets, of which 18 years have been into fund management itself. He has got a global experience and in United Kingdom and in India, of course, is where majority of his experience has been. He combines a philosophy, very interesting, of focusing on return of capital along with return on capital. And he picked a very high point in the market to close his PMS at ICICI Prudential and return capital to the investors with handsome profits. He's managing InCred Multicap, small and mid cap portfolio, IVGF1, that's a AI strategy, and EPF. Aditya, thank you so much for joining us today. Welcome. We would like to hear your views on how you're looking at the markets and then the product construct and some of the ideas which go into making of this product. Thank you so much.
Thanks a lot, Jharna. On behalf of InCred AMC, a very warm welcome to all the listeners on the webinar. So I'll just start by saying that one of the things that we have been trying to sort of practice in real life is that when we started InCred AMC, the effort was to focus on two aspects of investing. Obviously, return on capital, which is very, very important when we evaluate businesses. We are investing in superior management teams when we put our money to work for our clients. But return of capital is equally important. And, very recently, I got this privilege for the second time in July of 2024 to return capital after returning capital in 2018 in the AIF format. Now, one of the context in the current market, which everybody should be mindful about, and this is what one of my mentors told me when I started my career very early, in my very early days in my career, dating back in 2002, was that the ratio of people who make money and lose money in the market always remains constant over a bull and bear market, and only possibly 20-30% people make money in the market, and 60-70% people lose money in the market. So that has been the guiding principle for us in terms of practicing return on capital and return of capital. Now, once we look at this construct of the market over last 4-5 years, I think so next 2-3 years are going to be very, very different from what we saw post-COVID, essentially, in the markets. And what we have, my experience tells me is that over last 3 bull markets that I've been part of, the first bull market that I witnessed in India was from extreme pessimism in 2001 to 2007. And that was a bull market wherein the emerging markets did very well as an asset class. The second bull market has been from 2014 to 18, wherein obviously, small caps did very, very well. And the third bull market was, post-COVID. Now, one of the things which is worth highlighting is that what we have seen in last 4 years transpiring, essentially, and this is a very, very simple way to think about markets today. And I would say that, investing is very, very easy in the hindsight. If you look at the long-term trendline data of earnings growth in India, and you look at the 10-year data, what you'll find is that the earnings growth number possibly matches with the nominal GDP growth number in this country, which is, more like a 12% sort of a number. Now, what does that number imply, or what does that number, sort of mean, is that there is a 6-7% GDP growth and there is a 5% inflation element in the nominal GDP growth number. And that is what we have seen. Incidentally, that is the kind of return that we have seen of Nifty getting delivered over a long period of time, or let's say, last 10 years. Now, we believe that what happened in a COVID year, obviously, was that the index itself or the earnings went through a period of shock let's say the Nifty EPS was 100. Now the Nifty EPS declined and the Nifty EPS became 75. From the 75 rupees base for last 4 years, we grew at 25% earnings growth rate on a very low COVID base. Now the long-term average number is 12, and obviously there were certain sectors which grew at more than 25% number also. Now these sectors typically comprise of two sort of companies. One is companies wherein earnings seriously took a beating. Possibly auto was one such sector, or a lot of commodities. Wherein we saw a very sharp decline in price action post COVID, essentially. The second element has been sunrise sectors in the economy, which have grown. All the new age businesses, renewables, solar, a lot of the shipbuilding companies, or a lot of fancied sector in this bull market. So what we saw in these companies was that earnings grew at 30-40%. Now these obviously were favored by the market, but what we do believe is that in the coming next 2 years, we are in a earnings reset environment. Now, if you logically think about this more, you grew 25% in terms of earnings growth, and FY25 has been a clear miss in terms of earnings growth. We started this year with the expectation of 10 to 12% earnings growth, but we ended up possibly we are going to end this year at a 4 to 6% sort of a number. Now, when you fall from a very high growth phase, earnings have possibly fallen off the cliff. Now, one thing that you also need to recognize and remember is that there is a considerable element of cyclicality in index earnings. So part of the index earnings, Reliance is a very large part of index. It is possibly 10% of the index weight. What we have seen as far as Reliance is concerned, the fortune of Reliance as a stock price would be dependent upon what the crude oil price does. And the fortune of crude oil price obviously is dependent upon what the US is trying to orchestrate globally. So our view is that, and that is one of the precise reasons why, Reliance, the stock price has been under pressure. Now you look at, financials or auto, we also know that, these are domestic cyclical sectors, and there is a cycle. When I say there is a cycle to buy these stocks, the best time to buy a auto stock or a stock like Maruti is when passenger vehicle growth is negative in a country like India. It could be, minus 2 or 3% decline. Because for a fact that with the car penetration that we have in India, that minus number or minus 2-3 number print is not going to last. So that is something that we need to remember, but there is considerable element of cyclicality of financials, commodities, oil and gas in the sector, right? So roughly in our estimate, 55-60% of the index earnings themselves are cyclical. What we believe is that going forward, we would be in an earnings reset environment. We will mean revert to this 12% earnings growth rate. The second half is going to be materially better in terms of earnings growth. One thing that I also want to point out today is that, there is a lot of pessimism out of, after the correction in the market. But if you look at the price to book of MSCI India relative to MSCI World, it is trading at 2 standard deviation below its historical average, and it has only happened third time in last 20 years, wherein India is relatively cheap to the world in terms of relative attractiveness. And this leads me to believe that all this talk about, FI selling, FI ownership at a 10-year low, possibly, we are looking at a period wherein this might reverse very, very quickly, because it is all determined by where we are in terms of valuations today. Now, one of the biggest dilemma that value investors like, us have faced 6-9 months back was that, I have never seen a bull market in my life wherein month on month markets went up for 16 months. So from March of 2023, essentially, we saw every month, possibly market being up. And it is exactly opposite, what we are witnessing today. In fact, just to point out this, I don't know how March is going to end up. But typically in a bull market, what we have seen today is that uh, last time this happened in 1996, wherein 5 months in a row, Nifty is down month on month. So we believe that the odds are in favor of a pullback rally of some sort. Obviously, we have started to see some sort of that pullback rally happening at this juncture. The biggest dilemma that we faced was that how do we find value stocks in a market like this, right? So if I'm a dividend yield investor, let's say 6 months back, there was nothing that would qualify to be a part of the portfolio, wherein I would have, screen companies on a 5% or a 10% dividend yield. But today, if you look at, companies like oil and gas companies, which are the marketing companies, IOC, BP, HP, you can find dividend yields in excess of 8 to 10%. You can find a Vedanta at an 11% dividend yield. So my view is that irrespective of the style of investment that you follow as an investor, whether it is contrarian, it is value, or it is growth at a reasonable price, you can position your portfolio. We also have started to believe that there are certain areas wherein risk to reward has now become, very, very attractive, and it has become asymmetric. And I'll just highlight, why do we believe so? So the best combination to buy in today's market, what we believe is that wherein earnings have been cut, multiples have been cut, and promoters have started to buy. So what we have seen in last 1 month is that wherever we have seen promoters buying, those stocks possibly are bouncing also 30-40% from their very recent bottom that they have made, because we believe that insiders know the game better than what you and I know about. So if promoters buying is a very, very powerful combination, and this is one framework that I've used through 6 bear markets in my career, wherein multiple getting cut, earnings getting cut, and promoter buying makes a very, very powerful combination. Another thing that we have to be focused on today is that today market multiples are much more reasonable. We have got derated from 24 times to 25, 20 times earnings multiple on the Nifty. And obviously the level of complexity and looking at Nifty wouldn't do any justice, because if I look at, the broader market, there are multiple companies which have corrected, to the tune of, 30, 40, 50%. So I'll just, touch upon that later. But we believe that, this is a time to reflect. Every bull market, obviously, comes with its own share of mistake or errors. And we as investors, it is our sort of endeavor not to repeat the mistakes that we made in the past. We can, continue to make new errors, but our endeavor is to not to repeat those mistakes. So how we positioned our clients, in last 8 months is that point number one is that, in July, we ended up returning capital in one of the AIFs, done it second time in my career. And we had compounded at 23% CAGR in a flexi cap sort of a mandate. We started to slow down our decision-making process 6-9 months back. Absolutely zero participation as far as IPOs and QIPs are concerned, because we do believe that, typically IPOs and QIPs only happen in times wherein market is doing well and the business is doing well. And that is the worst time to put your money to work. And we also positioned our clients by focusing more on sectors wherein we saw minimal risk of earnings downgrade coming through. Obviously, these were sectors like IT and healthcare, wherein what we said is that, the best of the even if the slowdown happens, these companies will fairly stay insulated or protected in a down cycle. And we went, massively underweight on financials and auto. And this is a positioning that we are, at this juncture changing. Now, let us look at, how brutal this correction has been, essentially. So if you look at the decline in the, headline index, which is a Nifty, it has been only 12%. But if you look at the IT, FMCG, auto, traditionally, sectors which were defensive, we have seen a 20% plus decline. The small cap index, and this is as of yesterday, the small cap index has corrected by 20%. And the reality index obviously has corrected the most alongside media. Media has got, very, very insignificant sort of representation in the index, but this is how the fall has been. Now if you look at what has transpired at a market level, out of roughly 4,897 stocks in the market, we have seen the average fall in stock prices being closer to 38% in the BSE 500, right? And this gives you a clear picture of market capitalization buckets and what has been the average fall. So for example, more than 40% fall has been experienced in greater than 5,000 crore market cap companies. 30% of the universe has seen that kind of a fall. 61% of the universe has seen a 30 to 40% fall, and obviously more than 50% fall in 9% of the universe. So if you look at the cumulative data here, I think so we have seen quite a bit of correction, and this is how corrections typically happen in a bull market. In the earlier cycles, what we used to witness was that market or indices used to fall by 50%. Now this sort of pattern of correction has slightly changed. We get a 30% correction in the index, we get a 50% correction in a stock essentially, and that is how markets move. So typically in a 5 year, we know that we are trained to think like this, that you can have one down year. Now as an investor, what you can choose to do is that one thing is very, very clear, that one should be trying to fall less in a market year which is declining. But let's say in a typical 5 year cycle, there is 1 year wherein markets are down by 20-30%. There are 3 years wherein you make market determined returns in the market, which could be 10-12% thereabouts. There is one big year in the markets, wherein portfolio could be up 30-40%. So we believe that this is what happened from 2021 to 23. It was a sideways market, hardly returns in the portfolios. Most of the portfolios, as many of you would have experienced, were fixed deposit type returns. And then there is bunching up of returns in next 10-12 months.